Happy New Year, Mike.
So we all know that this is perhaps a year of some kinds of transitions, right? We're going to have policy offsets to some strong economic growth, most likely, and this inflation-fighting campaign by central banks is likely underway. I wonder what you think are the key distinctions this time relative to 2013 through 2015, when the Fed tapered and we eventually got a Fed rate hike in a slower growth economy, a slower nominal growth economy. Do we have enough of a growth cushion now, or are there separate factors that you think make it treacherous now?
So there's two distinct elements. On the growth side, I'm actually quite optimistic. I think the US in particular has momentum, and we will see solid growth this year. It's the inflation side that's new in a big way. It's not just how high inflation will get to, how long will this persist, and these two things are critical because they change behaviors. They change price setting behavior, they change wage bargaining behavior. But there's another question that, Mike, very few people are talking about. When inflation eventually comes down, why will it come down? And that's going to have a huge impact on the markets.
Play that out a little bit. So what would be the different ways it might come down and the implications of it?
So there's the orderly coming down of inflation. The Fed gets it just right, and demand eases a little bit, and the supply side response. That is the sort of Goldilocks adjustment. It's the one that we really are hoping for. But there's another one, which is the policy mistake. Because the Fed has been so late in adjusting, because the Fed grossly mischaracterized inflation as transitory, it has started late. And there's always a risk it was going to have to slam on the brakes. This is a 50-50 issue. This is not clearly in favor of the first orderly one. So we've got to keep a really close eye on why inflation eventually comes down in the second half of the year.
It's interesting, the idea of the Fed perhaps having to slam on the brakes to hasten, more rate cuts before perhaps the economy is ready for them or the markets are ready for them. It sort of assumes that there is a pain threshold for the Fed, that there's not a new framework that's going to let them be more tolerant of higher levels of inflation than there have been in the past. Is that something that, you think is open for question?
So I think the pain is there. I think when they look at a CPI is 6.8%, when they look at people saying that the core PC is going to go up, when they look at the possibility of a 7 handle, and this has become a political issue as well as an economic, social, and financial issue, the pain is already there. So they are having to play massive catch up. And the question is, at what point do they lose their nerve? I don't know what the answer is. I think the marketplace assumes they're going to get it just right. And the Fed has been incredibly supportive of markets. So the conditioning of the marketplace is to assume that the Fed will get it right. But economists will tell you that it is not a dominant probability. This is going to be really tough. The Fed has exchanged 70 record highs and the third year of double-digit return for the marketplace for a much more difficult 2022 policy outlook.
Does the way the bond market has absorbed this likelihood of not just a higher inflation for longer, so far anyway, but also perhaps 3 Fed rate hikes or more, in certain scenarios this year, does it tell you anything about, the market's ability to be resilient in the face of this? We have a flattening yield curve to some degree, but we obviously have not seen the kind of inflation panic running through the bond market.
We haven't, and that's because the Fed continues to buy, and we're not going to really see the genuine response of the bond market till the Fed stops its purchases. And that's going to happen in the first quarter of the year. But you've already had the sense in the bond market of let's keep an eye out for the policy mistake. You referred to it, it's been the flattening of the curve. So we have priced in quite a path for interest rate hikes, but further out the curve, we've also priced in concern about demand. So the bond market senses it, but it's not fully pricing in it yet because the purchases are so dominant right now.
What are the implications for the rest of the world here? If you just look at how markets have behaved, obviously Asia and emerging markets generally had a weak 2021. A lot of noise about COVID restrictions and things like that, and supply chain issues. Europe's done okay, but what would it mean if the Fed is going to be kind of leading the way in tightening policy or having less easy policy?
And that's critical, Mike, because if you look purely at valuation, as some people are doing, you are very tempted to rotate out of the US and Europe into emerging markets and China. That's what you would do if you were valuation focused. However, if the Fed is in play and if the Fed can end up with a policy error, you really don't want to do that. Because we know that when the US sneezes, the emerging world catches cold. Now, add on top of that what you mentioned, the zero COVID policy, which is going to be very difficult to maintain in China. I myself would not fade the US and Europe in favor of emerging markets and China because I am worried about the policy error. And I'm also worried about what zero COVID policy means for economic activity in China. But some other people, Mike, are advocating. They advocated it last year, they advocated the year before, and it didn't work out in either year.
Mohammed, let's talk for a quick sec about crypto, because we've been debating this now for years. I'm curious, in 2022, if what you're saying is right, does that mean people go out on the risk curve and that something like Bitcoin is a great investment? Or do you think that they actually do the exact opposite? We're right now, by the way, at about $48,000, a little under $48,000, $47,000 for one coin.
Andrew, it depends on what you think of regulation. I'm hoping that this will be the year in which the crypto industry and the authorities in the US in particular speak to each other and use a common language. And this is really critical because China is taking massive steps forward in this space. They're doing it differently than what the US would do, but they are starting to have an impact on global standards and how people think about this. So the big hope is this year, two parts that have not been talking to each other, that haven't even been talking the same language, would listen to each other and try and meet in the middle in order for us to have a common view on what the future of crypto is. If that happens, then the future of crypto is going to be much brighter than what it is now, because right now you have this big regulatory overhang, big cloud over your head.
See if crypto can bring us back toward multilateralism. Mohammed, great to check in with you. Thank you very much.
Thank you both, and Happy New Year.
Happy New Year, Mohammed.